An ETF, or exchange-traded fund, is a type of investment fund that is traded on stock exchanges, much like individual stocks. ETFs are designed to track the performance of a particular index, sector, commodity, or basket of assets. Let's delve into the key characteristics of ETFs. Firstly, diversification to ETFs provide instant diversification by holding a portfolio of securities, such as stocks, bonds, or commodities. This diversification helps mitigate risk by spreading investments across multiple assets. Secondly, tradability. Unlike traditional mutual funds, which are traded only once per day at the end of the trading session, ETFs can be bought and sold throughout the day, just like stocks. This makes them more flexible and liquid investments. Now let's look at some specific features. Index tracking. Most ETFs are designed to track the performance of a specific index, such as the S&P 500 or the Nasdaq Composite. The fund's holdings are constructed to mirror the composition of the underlying index, providing exposure to a broad range of assets within that index. Low costs. ETFs generally have lower expense ratios compared to actively managed mutual funds. This is because ETFs are passively managed, simply aiming to replicate the performance of an index rather than relying on active management strategies. Lastly, tax efficiency. Our ETFs tend to be more tax efficient than traditional mutual funds because they have lower portfolio turnover rates, which results in fewer capital gains distributions. Let's delve into the various types of ETFs available. First, we have equity ETFs, which track stock indices or sectors like the S&P 500 or the technology select sector SPDR. Next, there are bond ETFs, focusing on different bond indices or segments of the bond market, such as government bonds or corporate bonds. Then we see commodity ETFs, which provide exposure to commodities like gold, silver, oil, or agricultural products. Currency ETFs track the performance of different currencies or baskets of currencies. Lastly, leveraged and inverse ETFs use derivatives and leverage to amplify returns or losses compared to the underlying index or asset. Now let's talk about the benefits of ETFs. One major advantage is diversification. ETFs offer instant diversification across a broad range of assets or sectors. They are also low cost, typically having lower expense ratios compared to actively managed mutual funds. ETFs provide liquidity, as they can be traded throughout the day, giving you flexibility in buying and selling. They are also known for their tax efficiency, generally having lower portfolio turnover, which results in fewer capital gains distributions. Lastly, the transparency of ETFs is a significant benefit, as the holdings and composition of an ETF are publicly available, providing clear insight into the underlying investments.